Picture this. Your client, or maybe even you yourself, suddenly gets hit with an absolutely massive tax bill. Why? Well, simply because years of delayed salary finally arrived in a single lump sum, instantly pushing that income into a much higher tax bracket. It feels incredibly unfair, right? So how do we fix it? Today, we're going to break down exactly how you can protect against this using the new tax provisions.
Welcome to our deep dive on the subject. I'm thrilled to guide you through Chapter 9A of the Income Tax Act 2025, which is all about rebates and reliefs. Look, whether you're a chartered accountant, a tax professional, a business owner, or a CA student, getting a firm grip on these provisions is absolutely vital for the upcoming tax years. All right, here's our roadmap for today. We'll start with transition mapping, then hit Section 156 for tax rebates, Section 157 for salary relief, and Section 158 for retirement accounts. After that, we'll tackle compliance and practical issues and finish up with a quick summary and conclusion.
Let's jump right into Section 1, Transition Mapping, Connecting the Old to the New.
It's really helpful to see how seamlessly the rules you already know slide right into the new 2025 Act. That classic Section 87A tax rebate, that's now Section 156. Section 89 salary relief has become Section 157, and the fairly recent Section 89A for retirement accounts is now housed under Section 158. Oh, and here's a crucial tidbit straight from the official FAQs. What we used to separately call the assessment year and the previous year are now unified under one single, simple term, the tax year.
Moving right along to Section 2, Section 156, Tax Rebates. Let's understand the core rebate limits.
So, who actually gets this rebate? Well, it's exclusively for an assessee who is a resident individual in India. But here is the hard condition. Their total income for the tax year simply cannot cross the threshold of 5 lakh rupees.
If you do manage to stay under that 5 lakh mark, the law gives you a 100% deduction on your income tax payable, capped at exactly 12,500 rupees, whichever of the two is lower. And remember, this rebate is applied to the income tax computed before allowing other deductions under this specific part of the Act.
All right, Section 3. Section 157. Salary relief. This is all about managing arrears and advances.
So what's the big idea here? It's all about fixing a major headache known as the bunching of income. Imagine getting years of delayed salary or even family pension arrears all in one go. Boom! Your total income for that specific tax year suddenly spikes, pushing you into a higher tax bracket than you'd normally face. Section 157 steps in to neutralize that unfair tax burden.
Let's put this into perspective with a real-life scenario. Say a taxpayer gets 3 years of delayed salary today. Section 157 basically acts like a time machine. It looks backward and recalculates the tax as if that salary had been appropriately taxed in those correct past tax years. The relief you get is essentially the excess tax you're being charged today compared to what you would have paid back then. It's a lifesaver that completely protects the assessee from being unfairly penalized by a sudden bracket spike. Let's shift gears to Section 4. Section 158, Retirement Accounts. Specifically, relief for foreign retirement benefits.
The main goal of this section is to avoid messy double taxation mismatches. You see, foreign countries often tax your retirement account only when you withdraw the funds, but India might try to tax them on an accrual basis. This provision gives residents a much-needed mechanism to align that taxation. But keep in mind, it applies strictly to accounts in notified countries. And as per the current guidance, those notified countries are the USA, the UK, Canada, and Australia.
Which brings us to Section 5. Compliance and practical issues. Let's talk forms, deadlines, and pitfalls.
Okay, grab your notepads because this is where professionals often slip up. Please note this vital shift. The old Form 10E for salary relief, that's gone. Under the 2026 rules, it is now Form 39. And what was Form 10EE for foreign retirement accounts is now Form 40. Seriously, applying the old forms will absolutely get your relief claims rejected.
So how do you actually claim these reliefs? Just follow this simple 3-step process. First, accurately identify the eligible income. Second, calculate the relief. And third, and this is absolutely critical, you must file Form 39 or Form 40 electronically via the tax portal before you actually file the return of income. Now here is a massive warning sign derived directly from the official FAQs. You've got to warn your clients that choosing to claim relief under Section 158 using Form 40 is an irrevocable decision. Once a resident person makes this election for a tax year, it locks in. It applies to all subsequent tax years for all such accounts in that notified country, and there is no going back. It cannot be revoked.
In practice, you've really got to watch out for these common blunders. Like we just said, do not file the obsolete 1961 Act forms for a 2025 Act assessment. Form 10E is history. You need to be using Form 39 starting tax year 2026-27. Also, make sure you don't miss that pre-return filing deadline for these forms. And finally, double-check that the 5 lakh rupee total income limit is strictly adhered to when you're claiming that Section 156 rebate.
Let's wrap things up. Section 6, Summary and Conclusion. Here are your key takeaways. If you remember nothing else, remember these 5 transitions. Section 156 caps your basic rebate at 12,500 rupees. Section 157 is your salary arrears lifesaver. Section 158 handles foreign retirement accounts for the US, UK, Canada, and Australia. And update those internal checklists. Form 10E is officially out. Form 39 is in. Form 10EE is out. Form 40 is in.
So, as we fully embrace the 2025 Act, ask yourself, are your practices checklists truly updated to navigate this transition without missing a beat, or are you still relying on old habits? Think about it. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.